Hello and welcome to this short video presentation by Team 25. My name is Sri Krishna Pandey and I am one of the five members of the team. I will be giving you a brief introduction about the topic and the team members. To start off this video comes under the project given to us in the SPG course, and this is a milestone 2. So, what is the agenda of this video? The agenda of this video is to introduce to you about the topic, our team, our role which will be playing in the skit play. We have built a small scale app for the investment planning, and we will conclude by giving you the findings and the results. Okay, so about the long-term saving and investment, this has chosen to be the topic of our team, and what we look in the long-term saving and investment plan. So this is vital for financial security and goal achievement. This presentation explores the different benefits or differences between the saving and investment domains for what we will do in the financial stability the long term goal. So this will be broadly covered in this play. When we look about the investment option we have, we go through a immense amount of investment and saving plan. So we can save or invest on gold. We can look forward to saving accounts in the bank, liquid cash, and a fixed deposit in the bank. So this is the broad term of saving, and then we can go to the real estate business. We can go to the direct equity business. We can also serve a big role in the bond and RBI bonds and corporate bonds, which will be helpful in our journey. And last but not the least is mutual fund. Mutual fund is a good area to bring your investment goals into the real estate. So this is our team, which is led by Satya, Rohan, Adit, and myself are the team members of the team. We are students of BS. We all have done a immense amount of dedication, fully blown up the minds of our investment planning. We have given long hours of preparation through the books, or going over the internet, watching videos of the investment planning, and taking notes which are given by the working professionals and what. So this will be a full portray of what we have gone through over the month, over the 2 month period of this course, and we will be playing a skit play from very basic. We have covered from very basic to the very hard topic in this investment options. So we'll be acting as what you will see on your screen. So Sarthak will be playing a 30-year-old guy who has a high earning and low expense, and has a limited investment knowledge. Krishna will be playing a 40-year-old guy who is a high expenser but has a low earning and has a limited knowledge about the investment. Satya is a 26-year-old girl who has a moderate level of earning and expenses and has an intermediate level of investment knowledge. Adit will be playing a 25-year-old guy who has an intermediate knowledge about intermediate earning and expenses, but has a beginner level of investment. Rohan will be a 28-year-old guy who has a high earning and high expense and has an intermediate level of knowledge about the investment. So this will be a full play, which will be covered in this video. The video start off with Sarthak telling his friends about the investment topic. Satya will lead the role of telling and describing about the topics. Rohan will also come in to the picture about telling about the RBI bonds and something related to it. Krishna and Adit will be playing a little less lower role, but a good role, which will be asking questions about the various aspects of this investment and savings plan. So I will be giving the voice to Karthik. He will take the charge from here, and I'll be signing off. Over to you, sir.
Yeah. You know what, guys? I have been thinking about financial future lately. I think it's high time we start considering long-term savings and investments.
Absolutely. It's vital to plan for our financial independence and well being. We should explore various investment options available. Let's go and build wealth over time.
I agree, but we all have different financial situations and knowledge about investments. Let's make this fun and informative. We can discuss different options based on our unique circumstances.
Sounds like a plan. So, where do we begin?
Let's start with the basics. An investment is something you put your money into with the expectation of earning a return over time. The goal is to grow your wealth and achieve financial security.
Mm, I'm not sure I fully understand this investment stuff.
No worries, Krishna. We'll take some time and walk through it step by step. First, let's talk about the different investment options and types of options available for us. Okay, let's start with the safest options suitable for beginners like Aditya and you. These include liquid cash, savings accounts, and fixed deposits. They offer easy access to your money, but the returns are minimal. So, fixed deposits will be offer slightly higher returns, but you have to lock in your money for a specific period of time.
So, liquid cash and saving accounts are low risk, right?
Exactly. They offer easy access to your money, but the returns are minimal. Fixed deposits offer slightly higher returns, but you have to lock in your money for a specific period of time. Rohan, can you explain it a bit?
Yeah, sure, Satya. Let's start with savings. Now, savings have generate high interest earnings, easy liquidation, protection against inflation, and they are safe and secure. Whereas the downsides are relative low returns, risk of negative real rate of return, and minimum balance requirements. Okay, so that makes up for savings. Now we go on to liquid cash. Liquid cash have high accessibility and they are independent from financial institutions. They have high liquidity and no minimum duration. Whereas on the downside, we have vulnerability to inflation, no tax benefits, and no potential for growth. That makes up for liquid cash. Satya, can you please explain fixed deposit?
Sure, Rohan. So, fixed deposits are a low risk investment option and they are ideal for conservative investors seeking stability. The interest rates provide a predictable income stream throughout the investment tenure. You have several tenure options available, and you can easily access and start an FD from banks and other financial institutions. However, they relatively offer low returns compared to higher risk investments like equities. Lack of liquidity during the investment tenure might also be an issue, and it may result in penalties because of premature withdrawals. Inflation may erode the purchasing power of your fixed returns over time as well. So, that is about fixed deposits.
Oh, that sounds manageable. What's next?
As we become more comfortable with investments, we can consider gold issued by the government. They provide a hedge against inflation and market volatility. Okay, so gold has historically proven to be a safe haven during economic uncertainties. Diversification is also a benefit because it diversifies your entire investment portfolio, reducing overall risk. The ease of liquidity is also a pro, which makes it easy to buy and sell. The global demand for gold in various industries can support price appreciation. However, physical gold also comes with some cons. The storage and security is also an issue, and it may eat into overall returns if you want to store it in a locker. There is no inherent growth potential like businesses or stocks, and lack of income generation as gold doesn't pay dividends or interest like other investments. So that is about physical gold.
Okay. And what about gold bonds? Like, how do that work?
Okay, so gold bonds are essentially a way to invest in gold without physically owning it. The government issues them at a specific price linked to the current gold price. At maturity, you get the equivalent value of gold. Let's learn a bit about gold bonds. So, gold bonds have more pros compared to physical gold. They're safe and secure in investment, and they're backed by the government providing capital preservation. You can earn fixed interest income in addition to potential capital appreciation because of gold prices. There is no issue with storage and security since the investment is in paper form. They're tax efficient compared to physical gold, and the interest income is generally taxable, while capital gains tax may not apply upon maturity. However, we also have some cons. The interest rates may not keep pace with the inflation, leading to lower real returns. Maturity periods can be long, tying up your money and unable to liquidate. So, the price fluctuations in the secondary market may also impact the investment's liquidity. So, that is about gold bonds.
Are there any other type of bonds rather than gold bonds?
Yes, along with gold bonds, we can also invest in RBI bonds and corporate bonds. So RBI bonds are risk-free investments. They have a minimum investment of rupees 1,000. The interest rate is set at 8.05%, and the bonds will always pay 0.35% higher than the national savings certificate rate. But on the downside, they are non-tradable and non-transferable, and they have a maturity of 7 years. Okay, so that makes up for RBI bonds. Now, on the other hand, corporate bonds have minimum duration of 3 months, very easy liquidation, and have interest rate up to 7.6%. But there are some cons, which include high risks compared to RBI bonds. They are less secure than RBI bonds, and low risk bonds will have lower yields, and high risk will have higher yields. That makes up for corporate bonds. Sarthak, since you're earning well, you should diversify your investments. You could look into real estate or the stock market.
Yeah, real estate sounds interesting, but I'm not sure where to start with.
Investing in real estate involves buying properties like residential or commercial spaces and renting them out for a steady income. It is essential to consider location, property type, and potential for appreciation. So coming to the pros of real estate, they have a potential for appreciation in property value leading to capital gains over time, steady rental income stream, providing regular source of cash flow, diversification benefits, tax advantages such as reduction on mortgage interest and property taxes, and inflation hedge. But on the downside, there is illiquidity as selling property can be time consuming and costly, high upfront costs, including down payments and closing costs, market fluctuations can impact property values and rental demand, and management and maintenance responsibilities can be time intensive and may require additional expenses. That makes up for real estate.
You mentioned that stock market, isn't it risky?
It can be, but it also offers great growth potential. You can invest in individual stocks or opt for equity mutual funds where professionals manage your portfolio. However, the stock market involves market risk and requires thorough research. So let's take a look at direct equities. So it comes with pros and cons like any other investment. There is higher return potential. There's also ownership and control in companies. Uh, it customizes and diversifies your portfolio. You're also receiving income steadily through dividends. There's also flexibility in timing for buying and selling stocks. They are, however, subject to market risk. So, market volatility may lead to potential capital loss. Extensive research and analysis is required before we enter into the stock market. Lack of diversification compared to other investment options like mutual funds. We should never take emotional decisions and get company risks impacting investment equities. So what are mutual funds? So investors come and pool their money and they give it to the hands of a fund manager. This fund manager has professional knowledge and he manages your invests in securities. Once these securities generate profits and returns, they pass back to the investors. So this is how mutual funds work. There are several types of mutual funds. They can be broadly categorized into three. One is equity or growth funds. These invest predominantly in equities, that is, shares of companies. They offer higher returns and they are best for long term investments. Some of them are large cap mutual funds, mid cap mutual funds, tax saving funds, etc. The other option is income or bond or fixed income funds. These type of funds invest in income securities like government securities or bonds or debentures and bank certificates of deposits. These are relatively safer investments and are suitable for income generation. Examples would be liquid funds, debt funds, dynamic bonds, gilt funds, etc. If you're not sure on what to invest in, hybrid funds might be suitable for you. They invest both in equities and fixed income. So they offer the best of both growth potential as well as income generation. Examples would be aggressive balanced funds, pension plans, children plans, and monthly income plans, etc. So that explains mutual funds. Let's see what are its pros and cons. As they're professionally managed by fund managers, you don't have to do extensive market research. The risk is also reduced through diversification as mutual funds invest in different sectors. You can start with low cost investment, and the investment can be as small as 100 or 500 rupees per month. They are safe and transparent as they are highly regulated by SEBI. They also have tax benefits. Funds like ALSs offer tax benefits. They also have some cons. Some of the mutual funds have lock in periods. Uh, they also have fluctuating returns as they're subject to market conditions. Some funds might also have high exit load and expense ratios, which might impact your rate of returns. So these cover the pros and cons of mutual funds. Let's look at the steps to invest in mutual funds. So the first thing you want to do is pick an investment method. Do you want to go for an SIP plan, that is pay some money every month, or a one-time investment like a lump sum money? Once you pick an investment method, next is to set your goal. What is your investment objective? What are you planning on investing it for? Is it for your child's education? Is it for your marriage? Is it for your higher education? You have to set an investment goal. The next factor to look upon is time horizon. How long do you want to invest it for? So there are several durations and lock-in periods available for mutual funds. So you need to research that. And the next, and in fact, the most important is risk tolerance. Mutual funds are classified on risk basis as well. This classification is provided by SEBI. So you can go ahead and observe the risk appetite, observe your own risk appetite, and observe the funds and pick a fund. Once you pick a fund, these are the factors you need to consider. You have to look at its performance against the benchmarks. You also need to track the AMC performance. You need to look at its consistency throughout, say, 3 years or 5 years period. Also observe expense ratios and exit loads. One more factor would be fund manager's experience that is also publicly available. So you can consider all these factors and then make an investment. Also, make sure that you keep track of your investments. So these are the steps for investing in mutual funds.
Oh God, Satya. This is a lot to take. But I'm starting to see how different options can fit in our unique situations, right?
Yes, exactly. That's the idea, Krishna. The best investment strategy considers your age, risk, tolerance, financial goals, and current financial situation.
Yeah. So what about you, Satya? You seem to have good knowledge about investments. What do you prefer?
Okay, so I personally am a moderate risk taker and I like the growth potential of equity investments. I'm also into mutual funds because they offer diversification and are managed by experts.
Krishna, since you're new to investments, you might start with low risk options like government bonds issued by RBI. They are safe and the government guarantees them.
And I'm interested in real estate as an additional income stream. So I'll research the market and start small.
Okay, so we need to keep track of the rate of return, effective return, CAGR, real tax adjusted return, and internal rate of return. Everyone can't invest and save. It depends on personal earning, time, education, and other factors. You should always get advice from financial managers before investing in new portfolio. We can track stock market indices like Nifty 50, Sensex, Nifty 100, BSE 100. Do not blindly follow tips. Do not make large investments and diversify your portfolio and always have patience. We can use financial apps for hassle-free tracking. Several are readily available in the market.
Okay, so this has been a lot of things to understand. Thank you, Satya and Rohan. Now, what I have understood how this path of investment would look like, uh, I can tell you. So, we should start with the saving. We can start with the saving account. We have the liquid cash. We can save in the account. We can go to the fixed deposit if we want. And also, gold is a good option to invest upon. Then we can move on to the gold bonds, RBI bonds, and corporate bonds, which will be a mediator level of investment. And then we can move on forward to the direct equities, real estate. This will be a moving flow to the operations of investing, and then we can move on to the mutual fund. So mutual fund is a big task I can see in this uh, uh, tenure. But so we can start off with the saving and then move on to the investment planning for bonds and equities, and then to the mutual fund. This is what overall construction what my mind has developed right now. So this is too much to be honest. But
Okay, don't get tense, guys. To help all such beginners, two students of IITM BS made an application that gives personalized suggestions.
oh, that's great. From where we can access that?
Here's the link for that application. Aditya, can you show everyone how it works?
Yes, sir. So Sarthak, can you open the app? So this is the monthly income analysis app. So we'll enter our monthly income here and then our expenses like educational, food, rent, transport, and general other expenses. And then we click on generate report. So it will generate a HTML report down there, and also you can download the PDF report, and the option is given in the HTML report. So that's all about the application.
Wow, this is a wonderful way to track your expenses, I believe.
Yeah, correct. I can see the ease of this application. We can just put in the numbers and we can get.
Okay, so to wrap it up, Krishna, you can always start with low risk options like government bonds. As you learn more, consider equity investments for long term growth.
Surely, surely I can do that. Thank you.
You can invest in real estate for passive income, and Satya and I can help you get started.
That would be awesome then. Thanks.
Yeah. Good luck to our new journey to financial freedom, everyone.
Thank you.
Thank you.
Yeah.
Thank
Thanks.
you.
Okay. So hope you guys enjoy this skit play which we have performed. We have enjoyed working on it. We have explored various topics. We have taken up the challenge to see the long-term investment goals and saving plans. Uh, these are the broad topics which are a time consuming task to see and read about it, to understand about it. We have to go through a lot of research and lot of pages of work has been done. We have completed this and collapsed this in a small kit play, which will be helpful for the new learner of this investment plan, and that will be a great idea to start up. So for this project, we would like to thank the SPG team. We have worked a good immense amount of time in this app, and we love to do much more projects similar to this. And thank you from my side and team 25. We'd like to sign off and bye.